Imagine waking up tomorrow and discovering that nothing around you looks different. The roads are the same. The coffee still costs about what it did yesterday. People are heading to work as usual. Life appears perfectly normal. And yet, beneath that ordinary morning, a decision made behind closed doors may have already begun changing your financial future. Not because you spent more money. Not because you changed jobs. Not because you made a bad investment. But because a small group of policymakers adjusted a single number. A number that most people never think about. A number that has the power to influence mortgages, savings accounts, stock markets, business investment, inflation, and even the pace at which wealth is created, or quietly disappears. Here's the surprising part. Most people won't notice this shift until months later. By then, the biggest moves in financial markets may have already happened. Businesses may have changed their hiring plans. Banks may have adjusted lending. Investors may have repositioned billions of dollars. And ordinary families may begin feeling the effects without ever knowing where they started. This is the invisible force behind much of the modern economy. And at the center of it stands one institution. The Federal Reserve. To some, it's simply the Fed, a name that occasionally appears in financial headlines before disappearing again. To others, it's one of the most powerful institutions in the world, capable of influencing the direction of the American economy with decisions that ripple far beyond the United States. Whether you're investing for retirement, buying your first home, building a business, or simply trying to protect your savings from inflation, the Fed's decisions have a way of reaching your life, often without you realizing it. That's why every meeting, every statement, and every policy announcement is watched so closely by investors, economists, business leaders, and governments around the world. They're not just trying to predict what the Fed will do next. They're trying to understand what those decisions might mean for the future. But here's where things become even more interesting. The people who build lasting wealth often aren't the ones who predict every Federal Reserve decision correctly. They understand something much more important. They understand how the system works. They know that while headlines create noise, disciplined thinking creates opportunity. Instead of reacting emotionally to every announcement, they focus on the bigger picture. How economies move through cycles, how markets respond over time, and why patience often outperforms panic. Over the next few minutes, we're going to uncover why the Federal Reserve's next move could change your wealth forever. We'll explore how one decision can trigger a chain reaction across the economy, why most people misunderstand its true impact, and what history has repeatedly taught us about navigating uncertainty with confidence. Because by the end of this journey, you may never look at a Fed announcement, or your own financial decisions, the same way again. If someone told you that one number could influence the price of your next home, the interest on your credit card, the value of your retirement account, the hiring plans of major companies, and even how expensive your weekly groceries become, it might sound impossible. Yet that is exactly what happens when the Federal Reserve changes interest rates. At first glance, an interest rate announcement doesn't seem very exciting. It's usually delivered through formal statements, careful language, and press conferences filled with economic terms. For many people, it feels like news meant only for bankers or Wall Street professionals. But beneath those technical words lies a decision that quietly reaches into almost every corner of the economy. The Federal Reserve was created to help promote a stable and healthy economy. While it has several responsibilities, one of its most powerful tools is setting the direction of short-term interest rates. Think of interest rates as the price of borrowing money. When borrowing becomes cheaper, businesses are more willing to invest, families are more likely to buy homes or cars, and consumers often spend more freely. That increased activity can stimulate economic growth. But there is another side to the story. When spending grows too quickly, prices can begin rising faster than incomes. Inflation starts reducing the purchasing power of every dollar people earn and save. To slow that momentum, the Federal Reserve may raise interest rates. Borrowing becomes more expensive, businesses become more cautious, consumers delay large purchases, and the economy begins to cool. It is a delicate balancing act. Move too slowly, and inflation can become deeply rooted. Move too aggressively, and economic growth may weaken more than intended. This is why every Fed decision attracts so much attention. Investors know that a single policy change can reshape expectations long before the real economy fully reacts. Financial markets don't simply respond to what is happening today, they constantly try to anticipate what comes next. That means stock prices, bond markets, currencies, and business strategies often begin shifting almost immediately after the Fed signals a new direction. For most people, these changes feel invisible at first. There is no alarm announcing that the economic landscape has changed. Instead, the effects arrive quietly, spreading through banks, businesses, and households one decision at a time. By the time many families notice higher loan payments, changing investment values, or slowing job opportunities, the chain reaction has already been unfolding for months. And that raises an important question. If one decision can influence so many parts of everyday life, how exactly does that invisible chain reaction travel through the economy, and why do some people recognize it long before everyone else? The Federal Reserve doesn't walk into grocery stores and change price tags. It doesn't call banks and tell them exactly what mortgage rate to offer tomorrow morning. And it certainly doesn't decide which stocks should rise or fall. Yet somehow, one policy decision has the power to influence all of these things over time. That's because the economy works less like a collection of separate parts and more like a chain of connected dominoes. The first domino falls inside the financial system. When the Federal Reserve raises or lowers interest rates, commercial banks begin adjusting the cost of borrowing. Those changes may seem small at first, but they quickly spread through mortgages, auto loans, business financing, and credit cards. A family considering their first home may suddenly find that monthly payments have become more expensive. A small business planning to open a new location may decide to postpone expansion because borrowing now costs more. A young entrepreneur might rethink hiring new employees, not because demand has disappeared, but because financing growth has become more difficult. Now imagine thousands of businesses making similar decisions at the same time. Some delay investments, others reduce spending, hiring slows, consumers become more cautious. The pace of economic activity begins to change, not through one dramatic event, but through millions of individual choices influenced by the cost of money. Financial markets often react even faster. Investors are constantly looking ahead, trying to estimate where the economy will be months or even years into the future. When they believe higher interest rates could slow economic growth, they may become more selective about the companies they invest in. Businesses that depend heavily on borrowing can come under pressure, while companies with strong balance sheets and consistent earnings often appear more resilient. In other words, markets aren't simply responding to today's economy, they're trying to price tomorrow's possibilities. This is why headlines about the stock market can sometimes seem confusing. The economy may still look healthy, yet markets decline. Or economic news may appear disappointing, while markets rise. Investors are reacting not only to current conditions but also to changing expectations about what comes next. Perhaps the most surprising part is how quietly all of this happens. There is no single moment when people suddenly realize the chain reaction has begun. It unfolds gradually, through loan applications, business meetings, investment decisions, consumer spending, and countless everyday choices made across the economy. By the time the effects become obvious, the biggest opportunities, and the biggest mistakes, may already be behind us. And that's exactly why experienced investors pay close attention not just to economic data, but to something even more powerful, human behavior. Because when uncertainty grows, the greatest force moving markets isn't always interest rates themselves. It's the emotions they trigger. If markets were driven only by facts, investing would be much easier. Every investor would study the same economic reports, reach the same conclusions, and make rational decisions. But history tells a very different story. Financial markets are shaped not only by numbers, but by human emotions. And when the Federal Reserve changes direction, those emotions can become more powerful than the policy itself. Think about what happens when uncertainty enters the market. News headlines become more dramatic. Television panels debate whether a recession is coming. Social media fills with predictions of crashes or sudden recoveries. Every new economic report is treated as if it will determine the future overnight. Before long, fear begins spreading faster than facts. This is where psychology takes control. Human beings are naturally wired to avoid pain more than they seek gain. Behavioral economists have long observed that the emotional impact of losing money often feels much stronger than the satisfaction of making the same amount. That instinct may have helped our ancestors survive dangerous environments, but in financial markets, it can become an expensive weakness. When people see their investments falling, many feel an overwhelming urge to act immediately, believing that doing something is always better than doing nothing. Yet history repeatedly shows that emotional decisions often arrive at exactly the wrong moment. During periods of uncertainty, some investors rush to sell quality assets simply because prices are falling. Others abandon long-term plans after reading frightening headlines or watching short-term market swings. By the time confidence eventually returns, they often find themselves buying back the same investments at much higher prices. The cycle repeats itself generation after generation, not because people lack intelligence, but because fear clouds judgment. This is one of the greatest paradoxes in investing. Falling prices feel dangerous, even though they may represent future opportunities. Rising prices feel safe, even though they can encourage overconfidence and excessive risk-taking. Markets have a remarkable way of rewarding patience while punishing emotional reactions. That doesn't mean uncertainty should be ignored. Economic slowdowns are real. Businesses can struggle. Jobs can be affected. Market declines can test even experienced investors. But uncertainty has always been part of economic history. Every decade has faced its own challenges, whether inflation, financial crises, recessions, or unexpected global events. Yet despite those setbacks, economies have continued evolving, businesses have adapted, and markets have recovered over the long run. The real difference between those who merely survive these periods and those who emerge stronger is rarely perfect prediction. It's emotional discipline, the ability to stay calm while others panic, to focus on long-term fundamentals instead of daily headlines, and to recognize that temporary uncertainty is not the same as permanent decline. This mindset has quietly connected many of history's most successful long-term investors. They understood that wealth is rarely built by reacting to every headline. It's built by understanding the difference between noise and lasting value. And that raises an even more important question. If fear creates so many costly mistakes, how do disciplined investors prepare before uncertainty arrives instead of simply reacting after it begins? Asterisk. One of the biggest misconceptions about successful investing is that the best investors always know what will happen next. People often imagine that wealth is built by perfectly predicting interest rate decisions, timing every market rally, or avoiding every downturn. But if history has taught us anything, it's that even the world's most experienced economists and market professionals cannot consistently predict every move of the economy. The future is simply too complex. The investors who build lasting wealth understand something different. They don't spend all their energy trying to predict the next headline. Instead, they prepare for multiple possibilities. That shift in thinking may sound simple, but it completely changes the way they approach uncertainty. Imagine two people watching the same Federal Reserve announcement. The first immediately reacts. They read alarming headlines, check their portfolio every few minutes, and begin making emotional decisions based on fear or excitement. The second investor also pays attention to the news, but instead of asking, "What should I do today?" they ask a more important question. Has the long-term value of what I own actually changed? That single question reflects a mindset often associated with Warren Buffett's approach to investing. Rather than treating stocks like lottery tickets or short-term bets, disciplined investors view them as ownership in real businesses. A temporary decline in share prices doesn't necessarily mean the underlying company has become weaker. In many cases, the market is simply reacting to uncertainty, while the business itself continues producing products, serving customers, and generating value over time. Preparation also means keeping financial flexibility. Investors who avoid excessive debt and maintain healthy cash reserves are rarely forced into difficult decisions when markets become volatile. Instead of selling investments at unfavorable moments just to meet immediate financial needs, they have the ability to stay patient. In some cases, they may even be able to recognize opportunities that others miss because fear has pushed prices lower. Another characteristic of disciplined investors is that they accept uncertainty instead of trying to eliminate it. Every economic cycle brings different challenges. Inflation rises and falls. Interest rates change. Markets experience periods of optimism followed by periods of doubt. None of these cycles last forever, and none of them can be predicted with complete certainty. Preparing for uncertainty is often far more effective than pretending it can be avoided. Perhaps the greatest advantage of this approach is psychological. When your decisions are based on principles instead of emotions, headlines lose much of their power. You stop chasing every prediction and start focusing on what has consistently mattered throughout financial history: patience, discipline, quality, and time. Because in the end, the Federal Reserve can influence interest rates. It can influence borrowing costs. It can even influence market sentiment. But it cannot control one thing that ultimately shapes long-term wealth more than any policy announcement ever will: the mindset of the investor making the decisions. Every Federal Reserve meeting eventually becomes history. The headlines that once dominated television screens disappear. Financial commentators move on to the next prediction. Markets stop reacting to yesterday's announcement and begin focusing on tomorrow's possibilities. What once seemed like the most important story in the world slowly fades into the background. But the lessons behind those decisions remain. If you look back through decades of economic history, you'll notice something remarkable. Inflation has come and gone. Interest rates have risen to levels that once seemed unimaginable, only to fall again years later. Booms have created enormous optimism, while recessions have filled people with uncertainty. Entire industries have transformed. Technologies have reshaped the global economy. Yet through every cycle, one principle has remained surprisingly consistent: those who stayed committed to long-term thinking were often rewarded far more than those who spent their lives reacting to every short-term headline. This doesn't mean every investment succeeds or that every period of patience is easy. Markets can remain volatile longer than many people expect. Economic uncertainty can test confidence, challenge assumptions, and make even experienced investors question their decisions. There will always be moments when fear feels reasonable and caution feels necessary. The challenge is learning to separate temporary events from permanent realities. Interest rates will change because economies change. Inflation will rise and fall because demand, supply, and global conditions never remain constant. The Federal Reserve will continue adjusting policy as it responds to new information. These cycles are not signs that the financial system is broken, they are part of how modern economies adapt over time. What truly determines long-term financial outcomes is often not the direction of interest rates themselves, but how people respond to them. Some allow uncertainty to control every decision. They chase optimism during market highs and surrender to fear during market lows, constantly moving with the emotional crowd. Others develop a framework built on patience, rational thinking, and consistency. They understand that while no one can control the next Federal Reserve announcement, everyone has the ability to control their own behavior. That idea may be the most valuable investment lesson of all. Wealth is rarely built through perfect predictions. It's built through disciplined habits repeated over many years. It grows through thoughtful decisions, careful risk management, emotional resilience, and the extraordinary power of compounding. These are not exciting strategies that dominate breaking news, but they are the ones that have quietly stood the test of time. So as the world waits for the Federal Reserve's next move, remember that its decisions may influence the economy, shape financial markets, and affect opportunities along the way. But your greatest financial advantage has never been the ability to predict every policy decision. It has always been your ability to think clearly when others cannot, to remain patient when uncertainty feels overwhelming, and to stay focused on the future instead of becoming trapped by today's headlines. Because years from now, you probably won't remember every interest rate announcement or every market reaction. But the mindset you build today could shape your financial future for decades to come. And if you found this documentary valuable and want more deep dives into investing, economics, and timeless wealth building principles, be sure to subscribe and join us for the next journey.